Wells Fargo scrapped its product sales goals for retail bankers and may take further disciplinary action against its employees in the wake of a fake account scandal that has already led to $190 million in fines and the firing of 5,300 employees. Wells Fargo has been hit hard by allegations its staff opened more than 2 million bank accounts and credit cards for customers without their consent in a bid to meet internal sales goals. Politicians are calling for an investigation, and Wells Fargo and regulators are expected to testify in the Senate next week. Well, now joining us to discuss this is Bill Black. He's an associate professor of economics and law at the University of Missouri, Kansas City. He's a white-collar criminologist, former financial regulator, and author of The Best Way to Rob a Bank is to Own One, and of course, a regular contributor to The Real News. Thanks so much for joining us again, Bill.
Thank you.
So, Bill, it's been interesting to kind of see the fallout from this Wells Fargo scandal. I'm looking at the headline from Marketplace. Wells Fargo CEO John Stumpf has to resign now. And what's interesting is that purportedly Wells Fargo is one of the banks, one of the most respected financial institutions that hasn't been caught up in the scandals around the financial crisis because it did not rely on risky trades or complex derivatives to turn a profit. Give us your thoughts about this latest scandal and that narrative that's being put forth in the mainstream media.
All right, so starting with the narrative, Wells Fargo did engage in many of the practices, and Wells Fargo has entered into many prior settlements for criminal conduct during the crisis and the lead up to it. But you're quite correct that the narrative in big chunks of the financial press in particular is, oh my goodness, how could this happen? This is a place that was supposedly unusually clean. In the particular context that we're talking about, the newest frauds, and they're not new, even Wells Fargo agrees that this goes back at least 5 years, but the workers who are actually the Wells Fargo workers, the folks who blew the whistle on these frauds, along with Wells Fargo customers. So in fact, this is a place that has absolutely refused to clean up its house. And by the way, while it was firing over 5,000 of the employees, the people who were being coerced and not only encouraged, but demanded and praised by Wells Fargo managers to cheat, the person who was in charge of the entire consumer banking division was allowed to retire, praised as the model of what a banker should be by the CEO, and given millions of dollars with absolutely no clawback for the abuses.
If I'm not mistaken, Bill, there's some talk of having some of that money returned. I think he retired with like something like $17 million, but I think there's some talk of getting some of that money back.
Well, talk is a little late when you've done the settlement, right? You have your leverage as the regulators, and you should have demanded the entire bonus structure that this person got. Remember, she's running one of the largest criminal enterprises in world history. For that, you should go to prison. You shouldn't get paid bonuses. But it's worse than what we've been discussing. So first, the Wall Street Journal's phrase is that and this goes back over a year, was that Wells Fargo was, and I quote, the envy of the entire banking industry because of this cross-selling. So that's a phrase we haven't explained, but what this was all about was if you came in to Wells Fargo to be a customer for anything, including opening the tiniest account, the sales personnel were trained and coerced to try to cross-sell to you many other Wells Fargo products that you had no need for, that would be harmful to you in the sense of wasted money. from your perspective. And all of this made Wells Fargo unusually profitable. Indeed, Wells Fargo was the only major bank in the United States that broke out in its financial statements. These are the 10Qs and 10Ks that you file at the end of quarters and the years, how much money they were getting from the cross-selling operations. And what you're not seeing in the press coverage is that this became public many years ago because employees protested, because employees sued. In fact, the employees and customers got together and brought a suit against these exact practices 3 years ago in December 2013. In 2015, approaching a year and a quarter ago, Los Angeles County brought a suit making public all of these things. And through all that time period, this senior executive that got the 17 million, as you said, nothing happened to her other than good things. Wonderful things happened to her personally. So there was zero accountability. But more to the point, again, the key was cross-selling. And they weren't hiding that they were doing cross-selling. They were bragging to the world that they were uniquely profitable because they were cross-selling. They had T-shirts made up that senior executives were wearing, cross-sell. They had, in some cases, monthly and sometimes hourly and daily conferences in which if you didn't meet their quotas for this cross-selling, you would be humiliated and threatened with being fired. But here's the historical context all the coverage has missed. Again, Wells Fargo, international bank, big thing was cross-selling. Well, what was famous in cross-selling? The United Kingdom. And something we've talked about in prior programs of payment protection insurance. This was a 50 billion pounds, so roughly $75 billion scam. And there was another scam aimed at small business borrowers. This has been, if you follow international banking, one of the largest scandals in the world for 8 years. In fact, for 9 years. With, in the United Kingdom context, a major story in the big papers essentially every 3 weeks or so. So Wells Fargo was emulating this British scam that had gone on for 20 years, which produced, according to the parliamentary inquiry, all of the profits, all of the banking retail profits of British banks came from this scam. So that's the context in which Wells Fargo emulated exactly the same perverse incentive systems and this extortion of employees to do the wrong thing. And then if the individual employees got caught, well, then you fire the individual employee and you give bigger bonuses to the managers who are causing them to act this way. And the maraschino cherry on this disgusting Sunday was the interview with the CEO, Stumpf, of Wells Fargo, in which he said the bank didn't do anything wrong. It didn't have any perverse incentives. It's just that there happened to be more than 5,000 fraudulent employees, right? And who apparently got hired by somebody, but not by Wells Fargo, except that, of course, it was Wells Fargo. The whole story is preposterous, and it is, the media has also not brought to public the fact that, as I said, almost all of the hard work was done by the employees. Employees even did public protests in Wells Fargo branches to try to warn the public of these practices. Not only did employees get no oomph, positive oomph for trying to do this, they get, in most of this coverage, denounced as the criminals. It's just disgusting beyond belief.
Well, Bill, we've already discussed that no one's gone to jail for this or any other major scandal at one of these financial institutions. But I wanted to ask, do you have advice for Wells Fargo customers? Should they be moving their money out of banks like Wells Fargo and going to credit unions? Is that a good alternative, or do we need, at least on a short-term level, we've talked about long-term, deeper changes that need to happen in the financial sector overall, but on a practical short-term level, can people, talk with their pocketbooks?
Yes, and certainly Wells Fargo is the type of institution that they should take their money out of. There are some not so great credit unions, so I can't do an endorsement of them generically, but you're correct that on average, they are dramatically better on this score. We should also have a public banking option, like postal banks and such, that give plain vanilla accounts, which is what 98% of us need, and with absolutely forbidden to have any of this cross-selling junk. I want to emphasize the hard work, as I said, was done by the customers, by the employees, and by Los Angeles County that brought the suit in 2015, building on these whistleblowers. And you see almost no credit for that in the coverage. Instead, these federal agencies got held absolutely not a single individual accountable, not a single, and there were no admissions, right? There are absolutely no admissions in the settlement agreement. So this settlement agreement, principally negotiated by the CFPB, the Consumer Finance Protection Bureau, is disgustingly weak.
All right. Well, Bill Black, as always, thank you so much for joining us.
Thank you.
Thank you for joining us at the Real News Network.